Good afternoon, everyone, and welcome to this early stage investment panel, where we're going to discuss how the startup ecosystem has been changing. My name is Maria Halasz, and I lead the new ventures at UNSW. In our portfolio, we've got about 140 deep tech companies, quantum computing, AI, biotechnology, advanced materials, etc. Next to me, I've got an esteemed panel, but before I introduce them and before we launch in, we only have about half an hour to talk about some really important topics. And why early stage investment in this forum? And one of the reasons is that while we've been used to the thesis of investing in early stage companies, of really, several years of hard slog and bootstrapping and then, raising some money, scaling, and if we're lucky, then we make some money. That kind of paradigm has completely shifted. And when you look at companies like Lovable, I almost forgot my companies, and Midjourney, these are the companies that can scale, and even in Australia, when you look at Perler, these are the companies that can scale within a few years from 0 to 1 million, 10 million, or even 100 million size. So I guess the question is not whether the way we invest in these companies is going to change, but how we're going to respond and how the way we invest in them is going to change. So with this, I want to introduce the panel. Next to me sits Yash Varma, who is from Empress Capital. And I've got Georgie Turner. Georgie is from Tidal Ventures. I've got Maxine Lee from Skalata. And I've got Ben Simai from Startmate. And by the way, Ben shares a surname with half of my family. And I haven't had the opportunity yet to figure out why. But we'll do that after the panel. So first question to all of you. Can you quickly put us in a picture of how you fit into the startup ecosystem? Yes, maybe you can.
Excellent. Sharing is caring. Yeah, look, my name's Yash Varma, founder of Empress Capital and general partner. Look, we're a VC focus on early stage AI companies, so hence we've talked a little bit here at Wholesale Investor, but we're really excited by what we're seeing right now. We think this is a once-in-a-generation opportunity right now, particularly at the early stage, and so we really believe AI is changing the way companies will be structured, how businesses will grow, and so we think it's a massive opportunity. Hence, that's where we're looking at.
Thanks. Good intro, because I think that sentiment's probably well shared. So I'm Georgie Turner. I'm a partner at Tidal Ventures. We are an early stage technology investment fund. We're on our third fund at the moment. So we've got about 30 portfolio companies. We are currently investing a fund that will be about a $50 million fund size. And we will go out and just specifically find the best AI native software companies that we can find in the Australian market that are expanding from Australia into the US. So we've got about 6 investments so far in this fund, and we'll do another 15 or so. In terms of where we fit in, we're looking at tracking the early stage ecosystem and founders who have probably been chipping away at an idea for about 12 to 18 months, and we're coming in and giving them their first, I would say, institutional capital as a fairly large minority holder in the business that supports them through to a US Series A.
Hi everyone, Maxine from Skalata here. We are an early stage VC fund based in Melbourne, and we look to back founders that we think have unique insights and the endurance to build category defining companies. We have 2 funds under our belt on to raise our 3rd fund, so very much in that emerging fund category as well. And we tend to lead most of the investments that we make. I was telling Yash over coffee earlier that while we're a generalist fund, we do like for our founders to be specialists and people who come from specific industries and verticals where they do have that domain experience. They've been deeply entrenched into the ecosystem of that market. They know where the problems are, they know where the pain points are, and that's why they're on a mission to solve them.
Cool. And I'm Ben from Startmate. Can I just go rogue for 1 second here? This is like definitely not my usual crowd or room. Would love to know, and I was just listening to the panel before and kind of everything that was said there, very different side of the market, all about defensibility and being conservative, and like we're at the complete other end of the spectrum here. Just so I understand who's in the room, like by show of hands, has anyone heard of Startmate here? Okay, probably like half the room. And has anyone like invested directly in an early stage startup? And like mentored early stage startup? Okay, cool. So yeah, Ben from Startmate. We are kind of like the epicenter for early stage startups in Australia. We're kind of like the YC of Australia, if you know what YC is. We raise funds every 6 months. We invest constantly through every cycle in about 30 to 50 companies every single year. Really early stage. That's where we like it. We have our thesis is all around founders. So we're completely industry agnostic. And I guess we can dive in from there.
Thanks, guys. All of you have been talking about founders, and of course, when we invest really early, there are a couple of things we look at, and the most important thing that has been in my list, at least, is the founder, the quality of the founder. Now, how has it changed in the last few years since you're looking at these much smaller teams, you know, where a team of 3 people can take a company to $1 million ARR? How did your requirement for the founder change in this environment?
Me first? Well, look, we're a relatively new fund, so for us it hasn't changed at all. It's always been the same. I come from a founder background, so prior to starting Empress, I had a software business for 20 years. So for me, and probably to add to that, we have a team that's both technical, so people who have founded AI businesses, exited those businesses, and I've got a high-performance coaching background. So we try and bring that really into what we look for in founders. And so it's really around, this sort of coachability. We look at the founder's ability to stay the long term. If we look at the number one success factor for people, the word grit often comes up. There's some science behind that. And so we're often looking at why is someone going to stick with this company that they're starting over the long term, and money is only one part of that. And so looking for those traits, looking for founders that really not just understand their domain, but they can build, have the right sort of mindset is really important to us as well.
Anyone else wants to add anything to this? I guess what I'm thinking of more like the companies are changing from where you adapt AI and then you use it in part of your company, which still hasn't started yet, but let's hope that that's beginning. Instead of that, really, we're looking for AI native founders. So is that happening in your view? Are you looking at that in your company?
Yeah, absolutely. And I think our investment focus hasn't changed despite all of the growth and momentum in AI as a category. What we hold strong to is a problem-focused approach. So what is the problem that you're solving? What is the pain point? Is there a significant enough group of people who have that problem? And what unique insights do you have into the market? And what we find is that the industry insiders usually know how to navigate a skeptical audience. So they not only know where the friction lies around the edges when it comes to these industries, but how best to navigate a sales cycle that's unique to their background. Where previously we were open to, plucking founders out from large tech company X and having them work in industry Y, I think where we've seen success in our portfolio at least, and I'm not saying there's one approach that's better than the other, is that person who understands the industry nuance. They usually have the patience to understand that specific set of problems that need to be solved, and usually have that frustration so that over the long haul, they're committed to solving that for their customers as opposed to someone who's been dropped in. So that's the way that we think about it.
So of course, we're talking about grit and perseverance, which probably hasn't changed that much over the years. Now, Ben, you're in the middle of drilling down from 700 odd companies to 10 or 15 in the next program for Startmate. And you're in a cold face of when you're looking at founders. What are you looking for in the founders?
Yeah,
that might be different than what it was maybe 5 years ago.
Yeah, I think there's a lot of kind of maybe fear around AI and how it changes everything, but really it's just become like, it's not even an industry anymore. It's just a new layer that every company is now an AI company. If you're not using AI in your company, you're kind of behind now. So on that front, I don't think much changes from the way we look at companies. The only thing that really has changed, which is great for early stage startups, is that the expectation around speed has just gone up. So you can do a lot more with a lot less. It used to be maybe a few moons ago where a company might come to you and say, hey, I want X million to build out a prototype. But that's just so far from where we are now. You're expected to do way more with way less. So a company of 2 people, couple of co-founders, can do so much and build out an entire company just themselves and a few coding agents now with Codex and all the latest that's coming out of the AI world, which is really exciting. And also gives them, if startups weren't already a threat to big companies, there's so much more now because the big corporates are taking way longer to get AI involved in their companies. And so early stage startups have probably the biggest advantage they've ever had in history. So it's a really exciting time.
And you started to talk about the metrics that you're looking for. And one of them is, of course, burn rate to profitability. And that time has constricted. And so did the number of people you're going to need. So what are other metrics that you'd be looking at?
Yeah, it's really interesting. Like a lot of people, and it depends on your stage, look for different metrics. We have a really foundational, simple approach to investing, which is all around people. I think outsiders come into the space and think we're stuck in spreadsheets. It's like the complete opposite. It's all about reading people and the foundations of what makes great outlier founders. That's what we look for. Like there's no metrics we look for specifically. It's all about outlier founders, and that hasn't changed. Like we're looking for now in the 700 companies, we have a specific system and a framework. And I think a lot of people who are new to the space or coming into the space, you ask experienced venture people, what do you look for? And they'll often tell you very implicit knowledge. Oh, I have all this experience. I've invested thousands of founders. I just know when it's the right time to invest. And because of StartMate, we have to teach other people how to invest. We run a program teaching people how to invest in early stage startups. We've made a really explicit framework that's really stood the test of time. We've been running it for 10 years now. And it's a really powerful way to simplify all the confusion around early stage startups and focus on the foundations that matter around the people building the business. Because we're at this stage of the venture ecosystem, we're building a portfolio of people, not a portfolio of companies. And so it's actually quite simple when you drill down into it. You can kind of forget all the metrics and focus on the people and what makes them amazing. And that makes it a really simple way to invest.
Yes, I guess with StartMate, you're looking at really, really early stage investments. Yash, what's your view around metrics? What are you looking for, given that you're probably investing not at the very early kind of accelerator stage?
Well, look, we do invest early. We primarily invest in that sort of pre-seed seed stage, but we do look at later. We have a few later stage companies, and in fact, we have some really later stage ones with companies like Anthropic that we've invested in earlier. Look, I think it is the sort of big thing we're looking for. It is coming down to people. AI, and our focus is AI. I would say one thing for sure. AI is not the product. AI, it does come down to that ability to learn and adapt. And I think in this current market, with the changes that are happening so quickly, there's a couple of founders in the room I know today that I've had conversations with, and we've talked about I've been freaking out about over the weekend about this VO model. If anyone has not seen this, VO3, it changes the way changes the way we're going to have creativity in terms of video, and I think it's understanding how do I take these new technologies that are coming on and build businesses on the back of it that have some long-term value in it. So, I mean, when we're looking at metrics, sure, we can be looking at ARR and we can look at all these things. But one of the things with this phase, I think, is that a lot of the companies don't look like previous companies have in terms of metrics. And so if you look at, so I'll give an example. We have a legal AI company we've invested in. We're seeing the uptake of that go through the roof in terms of exponential use by lawyers of this product. And they're the indicators where we start to see that, hold on, people are really finding value in this. So we're looking for where we have these signals of use of the product is really growing. And so for us, that's a really good sign that the technology is finding that sort of product market fit. That's a big thing for us. And obviously there's all the financial metrics around ARR and getting to a particular level.
So I'm not answering any particular question. I'm just going to keep going on that thread. So what we're seeing now is you've got these kind of entry-level land products, and they take various different forms. transcription's a common one. Just simple information retrieval that never existed before is a common one. And these land products, and you guys will be familiar with this, they have massive wow factor on land in a way that your land products in traditional software just never had. So, you know, in traditional software, you'd have to really convince the user to cough up. And now there seems to be a willingness to pay or adopt new tooling. And really, like, you could say that that is just coming from the billions of dollars that has been invested in the underlying platforms, that CapEx that's gone into those platforms has created the ability for an app to exist and scale to 1 million of ARR without actually that much product built around it. That's not to be dismissive of those applications. I think that some of those applications are very interesting. To Ben's point, when you find a founder that can take that as a land opportunity and acknowledge that revenue as potentially, I've heard it called curious ARR, and they can go from there to say, I'm going to build some interesting sticky workflow, or I'm going to go and find some proprietary data or accumulate some proprietary data, like in a legal AI, for example. And from there, I am going to convince the customer to pay for my tool, not necessarily as subscription software as we were always accustomed to, and I'm going to deliver you another feature. That's going to be par for the course. In 5 years, there'll be 10 things that look just like you. It's more, can I start to convince the customer to acknowledge the fact that this tooling and this workflow is creating higher ROI than software ever created? And it's potentially becoming agentic, it's potentially becoming multi-agent, it's starting to interface with my other systems, it's reducing the need for me to hire a person to do that job. And then we are starting to get closer to this point of what AI really should be, which is charging for the work that it is doing. So we call these systems of work, and it's an evolving sort of thesis that is starting to play out. I think we're seeing very, very early first wave of this. But it's effectively the promise of like a cursor, for example, for other applications. I think there will be a lot of like really early ones that will go quickly, call centers, legal, professional services generally, software development and accounting are like really natural applications of the technology. And then there will be other industries where it will take a little bit of time. So, you know, because you are trying to convince a user to adopt a different kind of way of interfacing with technology. And then you need a founder who is willing to sit with that workflow for a period of time and do the work that the big horizontal players won't do, and go really deep on a vertical and understand the gray between the black and white data and the tacit knowledge to be able to build something that is actually agentic in its capability.
Yeah, sure. I was just going to add to Georgie's point around having an initial wedge into that ecosystem. And I think for a lot of the founders that we back who've seen success, they originally have a product in a very text-heavy, manual, inefficient industry, but because they've identified that as a salient point, and this is where some people go, you're crazy to do the amount of DD that you do, but a number of years ago, we looked at this borehole logging software company, Tablogs, that we ended up investing in. And I remember when I called up one of my LPs, who was a geotechnical engineer, just do a bit of light market DD on, is this really a big annoying pain point? And he literally holds up a stack of papers. It's like, you need to see the amount of stuff I have on my desk. It is so manual, it's so inefficient. This is terrific. And it usually starts off as, you know, a wedge of what would be quite a niche industry, but the power that that founder then has is they can then build out from that wedge into what is the operating system for these types of, you know, geotechnical engineers. And it's because he has that industry insight and that knowledge and that insider knowledge that makes it quite unique.
Thanks, Maxine. I think we're kind of juxtaposing the threat, Google and the big wallets coming in with their LLMs and, you know, fundamentally spending and requiring enormous computing power and huge budgets. And then what the other side is the opportunities, which is solving real problems, which probably hasn't changed. For our investors here, because as you could see from the hands, there are plenty of investors here who are interested. Could you all, and maybe start with Ben and then you can share the microphone, could you all just highlight maybe 2 or 3 opportunities that you see in that ecosystem?
around AI?
Keep it AI for now, yeah? We'll have some other areas later.
Yeah, sure. As I say, like AI is just the foundation layer for everything now, so it's like kind of not that interesting in some respects. But we're kind of seeing 4 categories. You've got the kind of hardware that sits underneath all of AI, like the data centers. Then you've got the LLM layer, which is all the big companies are playing in that space. And you've kind of got where most startups that we're seeing are playing either in the consumer space, applying it there, or in the enterprise space. And so in terms of opportunities, I mean, as I say, every company we're looking at, like the 700 companies, pretty much all of them will have some element of AI involved in them. So it's just everything's AI now. That's what I'm trying to get across. It's not like a specific couple of companies, a couple of opportunities. Everyone's playing in the space, and it's about where they're playing across that ecosystem. And as I say, most of the big players, the big funding, the big capital expenditure is in the hardware and in the LLM space. Very hard to compete in. But then in terms of the consumer and the enterprise space, I mean, the world's your oyster. It's amazing. Everyone's still figuring out how that's going to work, and that's the really exciting space right now for early stage venture. Yeah.
Maxine?
Sure thing. Just a couple of thoughts. I think when it comes, and I agree with Ben's point in that it's a part of everyone's roadmap. Otherwise, you're left behind. I think one thing to consider is with technical barriers starting to lower, I think the commercial and distribution hurdle has actually gone up. So it's not just about what wrapper you're building around these models for a specific application, for a specific segment. It's also what kind of unique advantage do you have to distribution? What kind of unique advantage do you have about your market? And how do you think about that moat? And how do you think about defensibility? There's a lot of noise out there, and I'd say, more than 50% of the leads that we have coming through our funnel each week are now companies that claim to be powered by or driven by AI. And I think Georgie mentioned one of the metrics earlier around curious ARR, which I like to call experimental ARR. So you'll sometimes see companies that have had this explosion of, ARR interest in customer growth in the first 3 months, only for those customers to churn really quickly thereafter, because what they've been sold is they've been over-promising and under-delivering the product.
So in terms of specific spaces, I spend all of my time looking at vertical applications. So I think particularly out of Australia, anything infrastructure layer and sort of middle infrastructure layer and then horizontal layer is just difficult to compete with. And I think, in general, whilst Canva was a massive success, just the odds and the likelihood of having another Canva is extremely low. But what we do have in the Australian ecosystem is like quite a lot of really deep technical capability within specific verticals. We've got a really strong professional services market. So I actually think we have quite a right to play in anything legal, accounting, broking, that kind of world that needs a lot of automation, I think, and someone to sit and actually do all the integrations required and do the end-to-end kind of workflow build out to service that customer set. I think there's a bit of opportunity still there, although that will get a lot of competitive tension globally. I think you want to look at like where Australia really shines in like product development capability. So wherever we have like specific industries where we create our own products, insurance, fast-moving consumer goods, we're quite strong on retail, although highly concentrated. So just like specific areas where we tend to have big players, where we have a body of like concentrated expertise, I suppose, in a founder set that would be able to come out and apply the technology. I think that the first wave of this comes through from the automation of workforce. And so I actually think that in-field workers they were really poorly underserved by traditional software because we didn't have multimodal. It was pretty hard to get anything on the edge on your device. You couldn't do we didn't have voice, we didn't have video, all of these like amazing modes that the LLM seem to interact really well with just were really underserved. And so I think anything in like aged care, healthcare, construction, anything that can serve the end user of the product really well in the field is actually going to be quite explosive in the first wave.
Yeah, the consumer end. Yeah. Yash?
Yeah, excellent. Look, I think we're investing in all of those. We do really focus as well on that, what we call vertical AI. There's probably a couple of terms that we're sort of seeing a lot of. There's a lot of AI washing, so everything is an AI company. We're seeing a lot of AI tourists that come along, and this ARR that we're talking about is people come along and they don't really use the products. But I think particularly that vertical. The other thing that we like to see is, we're not scared of investing where there is some hardware components, where there is something else that's unique. Whilst we don't, you could argue building on top of some of these large language models, is that really a business? But if we go back to the early days of the internet, you could argue the same thing about building on a database, and there's not a lot of defensibility of something like Facebook or, many other applications that we use a lot. So, look, I feel like we are just seeing, on specific areas around, robotics and genomics. We haven't seen a lot of those things that are going to come out. We're really excited by what we're seeing, but I really feel like there's just new business models that are going to come out, and we haven't yet seen those. So I'd say we're at two phases. The first phase is this automation. The second phase is the new business models, and realistically, we feel if we can get one or two of these businesses, they're going to really give us some amazing returns.
For the investors' sake here again, can we also highlight some of the risks in AI and generally in that field? And just focus on AI for now, because obviously it's got a very specific risks attached to it.
Look, it's a high risk, high reward, without a doubt. And we are rapidly changing. So when we started this panel session, we talked about what do we look for, and we talked about people. If you fall in love with your product, you are screwed. And so you have to continually evolve, and you have to look ahead. And a lot of what we think about is, there is a bit of history here. If we start to think about what could change, I think it's really important to really be looking ahead of what could happen, but build on top of not just features within an LLM or anything like that, but what value can you build around all that? And so ours is, the more people, and I had this conversation with someone already today, which is humans are inherently lazy. So if you make it really easy for people, even if they could do it themselves, they probably won't.
It's obviously a high risk because it's relatively early. So I would just, focus on the fundamentals of what does tend to de-risk. The best thing that can de-risk in the first couple of years of an early stage investment is having a really solid, ideally 3-prong founding team of people who have like really good, deep core technical capability. So people who are on the tools that can build something without necessarily needing quite a lot of funding behind them, because they can go pretty far with very little now. And I think obviously, early stage VC, embrace the risk, talk to people like us who do this every day for a living, who obviously have worked through how to do this at a portfolio level and still deliver a really good return whilst managing quite a lot of risk in the portfolio.
Maxine and Ben, 10 seconds each.
Oh gosh, okay. I think the way that we're thinking about this, maybe for some of the more deeper tech AI applications, maybe in health where the stakes are a lot higher, I'd be thinking about capital efficiency, and it's our job as investors to think about what are the inflection points or chapters that make sense for this company, and will they achieve those inflection points within the life of our fund, and have they thought about products in the near term that maybe have more market-ready customers that are willing to validate the commercial viability of what they're building in the long term.
Yeah, maybe just finishing on a call to action. I mean, I think the real risk here is not being involved, like sitting on the sidelines and not engaging. Like the closer you are to tech, the closer you are to future opportunity, whether that's as a country, which we need a hell of a lot more innovation, a lot more ambition, at a company level, or at an individual level for you, your kids, the future generation. Like get more involved at the edge of technology. Like Startmate is the earliest you'll see. Come speak to me. Like we have our funds, we cap them at 3 mil per cohort, and we kind of have maxed those out. But come speak to me and get involved. We're selecting right now. We let people into that ecosystem. We let you see it. We teach people how to invest in startups. So come speak to us. Get involved in the ecosystem, because the biggest risk is just sitting on the sidelines and out of fear or confusion or whatever it may be. Get involved. Start mentoring. See the startups, and you'll be well positioned for whatever comes next.
Thanks, panel. It was fantastic. We will have one question if anybody's got a question. We're actually out of time, but I just wanted to open it up to the audience. There is one question over there. There you go.
You might have to scream.
You know what? I'm going to stand up and take the microphone to you.
Hi, my name is KPS Kohli, excellent panel. And we do see a lot of AI adoption. So I'm a lawyer back home, and I did hear Mr. Varma speak that they invested in a legal tech, AI legal tech. and also medtech, I heard. So I just wanted to understand that as lawyers and also as medical professionals, AI will reduce a lot of probably the brain work that is involved, the grunt work that is involved, where there's a lot of brain is used. That will, of course, reduce the cost for the lawyers and maybe for the client. But how do you value all this? Because ultimately what AI will do will reduce the number of billable hours for the medical professionals and also for the lawyers. So how do you value this? Because ultimately for an AI product, the customer is the lawyer. It's not for the individual. Because if you want to make an investment, you don't go to an AI and ask him questions and decide your investment on its output. You have to go to a lawyer and also his experience, and then you take a decision. And we do see, and as a lawyer, I can tell you, we do see where lawyers got it wrong. And so the question is, how do you value it? How do you value an AI startup, which is based on law or medical?
Some of our panels don't actually value yet because they're early investors and they might invest in safe. But those that are,
No, I think it's a great question from a not necessarily a numerical how do we value it, but every industry is having this question. So you use lawyers as example. There's a new business model that's got to happen because the value, there's a race to the bottom otherwise, right? So you could argue I'm not going to use these tools because I'm going to bill less hours, which is what probably comes to mind for most people. However, as soon as your competitors start doing that and start to realize they can take on more customers, then maybe they could charge less. And from our point of view, with something like law, we go, well, isn't it better if people could have more affordable lawyers or legal fees? If we talked about medicine, we talked about almost every industry. If we talk about coding, couldn't we have cheaper ways to develop software? Now, if you're in those industries, you might initially say, oh, this is really bad. But I think what will happen is that people will be more productive. So we think there's a 10x productivity benefit to almost every industry from using this. So when you say, how do you value it? We value it. I mean, we think for the winners, it's going to be 10 times, 100 times more valuable than what they're doing. And we're seeing that. We talked about Cursor, a software company that helps people develop software. 1 million one year, 100 million the next year, just rapid adoption. I'll just pass this on to my colleagues, but I feel like there's massive value in what we're seeing. It may feel like it's devaluing, but for the winners, it's going to be really valuable. That's why we want to invest in this space.
Thanks, Yash, but we won't have time for any more answers, and I think you've summarized the response really well. Thank you very much.